Hi everybody, this is Colin Murphy and welcome to Torcana Podcast 19. So it's December now, we're approaching the end of the year, and a lot of investors I speak to on the phone are worried about mortgage interest rates and how the recent and possible future increases could affect their investment plans. A lot of people are getting nervous, trying to buy quickly before something bad happens. Who knows what's going to happen, but I thought it would be a great idea to invite Kristine Bredeau from Eagle Home Mortgage onto the show. I've known Kristine for a few years. She's helped a lot of our clients, particularly out-of-state clients, secure mortgages on rental properties in Tampa Bay. She's very experienced. She can talk from an investor's point of view, and I'm delighted she found time to talk to us today. So, Kristine, how are you doing?
Good morning, Colin. I'm great. Thank you so much for having me.
Oh, it's our pleasure. So tell the listeners a little bit about yourself.
Well, I've lived in Florida. I think I'm one of the very few Florida natives.
Right.
Lived here all my life. I have been in the lending industry for over 3 decades now.
Wow.
And that's just because I can't figure out what I want to be when I grow up. But I love it. I'm very passionate about it, and I'm just thrilled to be able to talk to your crowd today.
All right, well, glad to have you. So, listen, let's start with the elephant in the room. Let's start with interest rates. They seem to have jumped a half point or so after the election. People are worried about what might happen if the Fed increases the base interest rates again in their next meeting. So, what are your thoughts on these changes, and what can we expect in the next quarter or so?
Yeah, this is one of my favorite conversations, and you know, I watch the market by the minute. I have it rolling on my desk at all times, and I'm pretty good at reading it and knowing what's going to happen. The election day after November the 8th, it was like we did a swan dive off a cliff, and the value of the mortgage-backed securities really took a dive. People were pulling their money out of these secured entities and throwing it into the stock market. So everyone's, so anxious about Donald Trump being in office when, boy, they were anxious to get in the stock market and make some money, and they did. Those are the dollars we compete for. So when you see the stock exchange doing well, when you see NASDAQ doing well, usually the mortgage-backed securities is suffering from that. So we're almost a mirror image, the opposite of what happened.
Sure.
With the announcement of the Fed getting raised, okay, let's just face it, this needs to be done. And where the confusion comes, even in the media, is that those are consumer rates. Those are not mortgage rates. Those affect credit cards, cars, HELOCs, home equity loans, but not primary mortgages. Fannie Mae, Freddie Mac, these are all based on mortgage-backed securities. So when that happens, when the Fed raises the rate for credit cards, everyone panics, knee-jerk reaction. They take their money out of the stock exchange and they dump it into something safe, such as mortgage-backed securities. So historically, you're going to see mortgage rates do better when the Fed raises their rate. So that's a big misunderstanding when these announcements are made, even in the media. Even the media will say, oh, the mortgage rates are going to go up. They're not.
Okay, so you think even if the Fed increases their base interest rates because mortgages are linked to other products, other government bonds and 10-year bonds and so on, that they might actually fall, that people shouldn't be too concerned about interest rates jumping up, or could it happen because they've been so low for so many years?
Don't expect the world to change. I mean, we're not going to go back into the mid-threes, of course, but it's not going to hurt us. It's going to help us, and I think that that's a misunderstanding in the market. So yeah, I think it's going to help us, and I think the economy needs it. I need more people utilize credit cards and car loans, those sort of things. Right. And we need that number to get up.
Okay. All right. Well, look, let's talk then about loan to value. So I have a lot of people listening to this show who might be considering their first rental property, their first rental mortgage, others that might have 1 or 2 mortgages and are looking to accelerate that into the 3rd, 4th or 5th. I mean, what kind of interest rates and loan to values can people expect at the moment for a rental property?
There's been some recent changes, and the way Fannie Mae is looking at it now is, people can have 1 to 10 properties financed. Anything above 10 is a business, and it should be run as a business.
Right.
When we're talking about 1 to 10 properties, we're talking about 1 to 4 unit properties. So anything over 4 units considered commercial. So let's just narrow that down.
So they don't care if you're getting a loan for 10 duplexes or 10 single-family homes, as long as it's not, an 8-plex or a mini apartment block or something like that.
Spot on. You got it exactly.
Okay.
So, perfect. Anything, and let's separate one more thing too.
Sure.
The risk involved.
Mm-hmm.
We're talking single-family homes. When you get into condos, things get a little more complicated, Colin, and they get a little more expensive, and there's a little bit more hair attached to getting those qualified. But so let's just talk about single-family homes.
Sure. Yeah, let's stick to single families. Yeah, because I know condos are different. You got HOAs; it's a whole different ball game. So yeah, let's presume we've people looking for rental mortgages on single families.
So we're still able to get a PMI. Actually, we are able to get PMI for rental properties with as little as 15% down. Don't get too excited, because when you're talking 15% down, you're at a higher risk in the perspective of the lender. So even if you have a great a credit score, you might have a 780 credit score, you're going to have a higher interest rate. Just for an example, right now, you'd probably be in the low 5s if you're trying to put 15% down. Plus, you have the expense of PMI. Discussing PMI goods and bads is a whole other topic. I won't get real into that, but it's an added expense, and it's going to hurt your cash flow.
Right. It's like an extra insurance people force you to take when you get a certain type of mortgage, right?
It has to do with the amount of risk, and anything below 20% is going to require PMI.
Okay.
If you did 20% down, no PMI, decent rate. And then if you put down 25%, that's where the rates start to get a little bit more attractive. The more money you put down, the less the risk, the better it's going to be for your interest rate. But 20 to 25% is where most of my investors start at.
Okay, so if we're at an interest rate in the low 5s for a 15% deposit, what interest rates are we looking at ballpark for 20% and 25% deposits?
Probably the higher 4s. I've seen 4.625, 4.75, 4.875, and that's based on credit score, that type of thing. Additionally, cash out refinance. If you own a rental property, free and clear, or even have a low balance, and you wanted to do a cash out refinance, you can borrow up to 75% with taking cash out. Okay,
so if they have other properties, they can borrow up to 75% on those. And what interest rates do they get on that? Because that's like an equity release, right? So what are we talking about there for interest rate?
You're going to be in the high 4s, right at 5, just depending on risk.
Okay, because that is something, an option people often overlook. They kind of assume I'm buying a rental property, so I'm going to get a mortgage on the rental property, but they could be sitting on a $300,000 or $400,000 or $500,000 house that's got a $70,000 mortgage on it, and they could actually release a decent amount of equity through home equity line, right? What advantage would that give people?
Some of the most successful investors start this way. What they do is they typically take out a home equity line of credit on their primary residence to get them started. It's going to give them the best interest rate, the lowest closing costs, the best tax write-up. I'm not a tax professional, of course, consult one.
Sure.
Then what they do is they buy their first rental property cash. You're going to have the most negotiating power. You're going to have the best ability to, have liquidity. Then you get in there, you fix the house up, you get a renter, everything's shiny and pretty, and you own that house free and clear. So now you're ready to buy your next one. So you take out a cash out refinance, and you take that money and you buy your next one cash. So you can see how it kind of rolls. It's going to give you the most negotiating power and give you the most ability to set yourself up for the right financing for the next one. So it's a good way to go, and a lot of my folks really enjoy that option.
Yep, no, I would tend to agree. And like you say, closing costs for finance contracts can be quite expensive. I mean, if a typical $100,000 property, a cash buyer is probably paying about $1,200-1,300 in closing costs, but a finance buyer could easily be paying $3,500 once you add up all the appraisal fees, application fees, lender's title insurance, a whole bunch of stuff that is linked to each individual mortgage you get. So as you say, if you can get pre-qualified for a nice fat home equity line of credit, you can just use that as and when you need it, almost like using your house as a credit card, but with lower interest rates and lower closing costs.
Absolutely. And then you've only paid those closing costs one time. So even if you pay that off and use it again, there's a lot of places out there that will even do no-cost home equity loans as long as you keep the line of credit open. It doesn't mean you have to have a balance, but you have it open. As a general rule of thumb, on the purchase side, you should expect about 3.5% to 4% for your closing costs and prepaid items. Right. Naturally, things are going to vary with homeowners insurance costs and with taxes and whatnot for each individual property, but that's pretty accurate. Okay.
So talk to me about the loan process, let's say for just general rental property loans. What's the best way for people to get started? They've got their 20-25% saved up. They're kind of looking at different properties in Tampa Bay and they're interested in getting the mortgage process started. What is that and how long does it typically take? Is there something they need to do before signing a purchase agreement to buy a property?
Well, being prepared makes all the difference in the world, and you can know that you are going to be a good credit risk. You can know that you have great credit, you have assets, but nothing is better than getting with your loan officer if the financial institution you're working with allows it, and doing a full-blown pre-approval instead of just a pre-qualification. So let me define those for you just briefly in case you don't know the difference. A pre-qualification is a great conversation. It's a quality, detailed application, and please give the most accurate information you can because that's what the decision's being made on. Credit's being pulled, and then they're running the approval engine through DU, which is Fannie Mae or Freddie Mac, to get basically a credit qualification. So based on what you've told me, based on your credit, based on running you through this approval engine, you're qualified for this property, which is good. It's not great, but it's good. Great is when you voluntarily, because by law as a lender I can't ask you to do this, but voluntarily you say, you're going to give me all of your bank statements. You're going to give me 2 months normally is what's needed. Okay. You're going to give me your income verification, and of course it will vary from person to person, and the necessary things that are required. And you can actually be underwritten by an underwriter. So really all that's missing is the plug and play of finding that property. You're going in halfway through the process already. Now, the process normally takes about 30 to 45 days depending on what lender you're going with. So if you have a full-blown pre-approval, I have some right now in my pipeline, they're out there and they're actively seeking properties. They go to contract. We've already run them through underwriting. We get the appraisal order. We get the title order. We get the insurance lined up, go back through underwriting with those final things being completed, and they're done with the process. It's a much stronger, solid experience than the variable of, I'm under contract. Are we going to close or not?
It sounds like it makes a lot of sense. I mean, if people have made up their minds that they have some real estate goals that they want to acquire 1 or 2 or 10 rental properties, they may as well just go and get pre-approved because buying a property is stressful enough. And if you can do a lot of your groundwork in advance of selecting the property, that's all the better. That gives you more time to do due diligence on the property where you're not getting distracted by doing a ton of mortgage work in addition to figuring out what property you want.
Well, what's even better than that is some of my repeat investors know that they can call me up and say, hey, Kristine, I found a property. I need to get it. I can confidently tell them, I've done 5 properties for you. I know you're going to qualify. I can do your letter, bim, bam, boom. It's that relationship. It's that experience. It's that flow. We know exactly what the underwriter wanted last time. We'll go ahead and hey, give me these 3 things that we need always, your bank statement, your income, blah, blah, blah. And it's just a smoother, more confident process.
Okay, no, that's great. No, I agree, and I think, people should definitely consider the pre-approval process versus the pre-qualification process. I mean, both are far better than nothing, but pre-approval, you're doing yourself a favor. You're being more prepared to make your first few investments. So, Look, credit score is obviously a big factor as well when you're applying for a loan. If you have if you have a poor credit score, your options are going to be more limited than someone who has a credit score 750 or 780. So, have you any tips for people out there that have an okay credit score but just not quite high enough to qualify for the best rates? What kind of steps can they take to improve their loan options?
By far and in large is your credit usage. If you have credit cards out there, we all do, and you should actively use them, first of all, because that's creating a score for you. A lot of times people will say, I'll just pay off my credit cards. Well, don't do that. That can actually lower your credit score. First rule of thumb is your aggregate credit, high credit limits, okay, or even just look at the individual. Say you have a $5,000 credit limit. That balance on that credit card should never go more than $2,500 to get the best credit score out of it. So 50% of usage of your credit cards is key.
Okay.
If you have a $5,000 credit card and you have a $500 balance, a lot of times people say, well, just pay it off. Well, don't pay it off. Leave it at that balance or pay it down to $100 or leave your gas on there or something. You're going to get a better score with having a balance on there than not having a balance.
Okay. And anything else?
One other thing is do it before you start applying for credit. One of the things that's being cracked down on right now is back in the day, not so long ago, people would come to the loan officer would pull credit. Then they'd say, well, now we're going to do all these things and change it. And their loan officer winds up pulling the credit 2 or 3 times during the process. Well, Fannie Mae and Freddie Mac are starting to crack down on that. They're saying that the loan officer is manipulating the score for the purposes of qualifying. So my advice to you on all of this, because that's going to get tighter, most likely, would be prepare yourself. If you know you're going to be buying in 3 or 4 months from now, go ahead and do all of your pay downs, you're lowering your balances, all those things ahead of time before your credit starts getting pulled by your lender.
Right. Makes complete sense. Okay, makes complete sense. All right, so let's pivot now and talk about foreclosures, because this is the flip side of the mortgage market. This is the other side of the coin, where banks take back ownership of properties that borrowers have defaulted on. And obviously back in 2009, 10 and 11, Florida in particular was completely saturated with foreclosures, and they made up a pretty high percentage of the overall market, people buying foreclosure properties. So how's it looking now in 2000 and late 2016?
Well, I think that they've employed some wonderful strategists, especially, and I'm going to just address Florida because that's what I know the best.
Sure.
I know that there are still a ton of foreclosure, pre-foreclosure properties that are out there. Fannie Mae has done a very good job at trickling them out, spacing them out. This is business. They're not trying to dump their properties. They're not trying just to get rid of stuff off their books. They're trying to make the most money they can and write off. So, they've bled pretty hard from this whole experience.
They did. They used to be dumping foreclosures when their cash flow was really bad, but now supply in places like Tampa, it's like 2.5, 3 months. It's extremely tight.
Right.
They really are just drip feeding stuff onto the market.
And they're smart. They don't
Sure.
need to just lowball things. So when folks come in and go, I'm going to buy a foreclosure, and thank you HGTV for making it look like it's a magic spell to fix the house up overnight. But the concept has become that they're pricing these properties effectively. They're looking at the house. They have professionals that are looking at it, and they're saying, okay, this is the condition it's in. This is the market. We're going to price this according to market. So and I'm just going to use round numbers. So where they put the house on the market for $100,000 and it's in poor condition, someone coming in and saying, well, I'm going to offer $60,000 or $70,000. Those days are kind of over. You might be able to negotiate a little bit, but not very much. Having cash and being able to close quickly is king. So that goes back to what we were talking about before. If you had that home equity line of credit or a cash out refinance, where you're able to say, look, I can close in 10 days. It'll save me $10,000. That might be something there. Now, that being said, if it goes on the market and it's in really poor shape, and Fannie Mae has a strategy. They're smart. They're going to say, okay, it hasn't sold. We're going to go ahead and pull it off the market. We're going to send our people in. We're going to fix the property up. Certainly not to like glamorous levels, but enough to be suitable. And then they're going to put it back on the market for a higher price. So that's kind of what's been going on now for the past couple of years, and it's working, and they're doing a great job, and they're pulling themselves out of the hairy, scary place where they were at. So I just want people to know it's not what you think. It's not that you can lowball and they should be happy to be getting your money. That's not the way it is.
No, you could do that in 2011, but that was a long time ago.
Yes.
And I see this all the time. You go onto the HomePath website, that's the Fannie Mae website. They've always got properties on there, and most of them are fixed up to a pretty good condition, and also they offer priority to first-time buyers. So they usually leave 2 weeks, sometimes 3 weeks for first-time buyers to buy the property. So if you're an investor, you're just going to have to wait until all those guys look at it and then submit your offer. So as I say, if something's more or less rent ready and you're submitting a low ball offer, look, I've tried it. It generally doesn't work. You get them sometimes with a property that's in bad condition, and because I'm making cash offers, I'll get them then. But if you're kind of making a finance contingent offer as an investor on a rent-ready property, you need to be pretty much at market rates, in my experience. And I would agree. They've got their act together. Fannie Mae and Freddie Mac are both very profitable companies now. They've paid back the money they borrowed from Uncle Sam, and they're drip feeding the market to get the most out of the stock they have. But I guess there's this shadow inventory, right? I mean, are banks still sitting on huge volumes of poor quality loans that will eventually need to be flushed out?
It's much more managed now. They've done good things with offering loan modifications, which are not freebies. I mean, it's tough to qualify for a loan modification when that loan modification might be a temporary Band-Aid to lower someone's payment, their interest rates, things such as that. They're working with people. They don't want to take these properties back. They don't want it on their balance sheet. Mm-hmm. One of the other things that a lot of the banks are doing is they sell to these great big investors. Blackstone was one that came into the Tampa Bay area,
right,
and just bought up every property they could, and they're using them as rentals until the market comes back, and then they'll trickle them back and double their money. So there's lots of strategies employed. There are a lot of foreclosure properties out there, but it's not just this volcano eruption anymore. It's all very controlled.
Right, because foreclosures used to be a big percentage of the overall market, and now it's shrunk right down to 10-15%, I think. And I guess that's a deliberate strategy. They could increase that if they wanted to, but they don't need to. They've got stronger balance sheets, and they'd rather just drip feed them out and maximize the value, I guess.
Well, and it hurts values. It hurts property values for homeowners. I know in my neighborhood, took an enormous hit. We had some very big foreclosures, and the sexy part of that is that it lowered all of our taxes, and because we have homestead exemption, they can only increase 3% per year. Mm-hmm. But on the other side of that, it's taken years. I mean, just now in my neighborhood are we starting to see, I can tell you right now, my house was appraised in 2006, and I am still $75,000 away from that value, and that's how bad it hit my neighborhood.
Wow, it's 10 years ago, right? It's incredible.
Yep.
It's incredible. No, that's true. So look, I mean, I'm an investor. I buy a lot of foreclosure properties and auction properties, and I'm hoping to get a couple more before the end of the year. Is December a good time to purchase from a bank? Do you think the people want to get rid of stuff off their books before the end of the year? Are you seeing any of that from your standpoint?
Yes, absolutely. Again, they're a business. I'm a business. The end of my fiscal year was November the 30th. Everyone has different ends of fiscal years, but most of them are the end of the calendar year. Mm-hmm. So they're in a rush. Now, I've heard things about, incentives for the property managers and things like that they get the property sold by the end of the year. But you're going to have your best negotiating power at the end of a quarter, at the end of the fiscal year, such as now, and with cash. Those are all going to give you great bullets for your gun.
Okay. Yep. Okay, that's great to know. That's great to know. So, okay, well, let's kind of move on and wrap it up. This is really, really good. Have you any final words of advice for people out there who are thinking about jumping into the property investment market?
Yeah, if I had to leave your audience with one thing is, be prepared, have the right expectation. Again, I go back to HGTV because I laugh about it. I'm addicted to those shows. In fact, I've got workers at my house right now working, but, there is so much more to it than face value. It's not a get-rich-quick scheme. For those folks who are serious investors, for those folks who are looking for long-term cash flow, it's brilliant. It's a wonderful opportunity, but know that there's going to be repairs to the house potentially that you're going to have to budget for. Know that you're going to have to take into consideration the expenses with getting the mortgage and being prepared ahead of time. Please get a home inspection by someone you trust, not just yourself. There's great companies out there that will snake the pipelines and make sure that there's not hidden things down there where a water main might break, or inspecting the roof. And there's so much to consider, because I'm going to tell you, Colin, I've seen people who got into this boat and were just trying to get the fast, quick deal and wound up losing everything they had cash flow wise because there were so many things wrong with the house.
Right. And speaking of which, I think it's fair to say, I mean, people might think, okay, I've got $20,000 in the bank. Let's try and get a 20% deposit on a $100,000 property. That's probably not a good idea. People need to have reserves for rainy days in their own personal life, first of all, but also they need reserves for their property, because, as you say, stuff is going to go wrong. If you get unlucky and you inspected it badly, stuff's going to go wrong at the beginning. But even if you do everything right, after a year or so, there's always going to be stuff that needs repaired, and you're always going to need money for something. So you should always have a certain level of savings. Like, you'd agree with that, right?
Oh my gosh, Colin, it doesn't end with the closing. You're going to have renters in there. Yeah, it's so important that you have money set aside, because you're going to be responsible if that roof leaks before closing and after closing to get it fixed. So yes, I agree with you completely. It's a big undertaking, but boy, what a reward when you do it right.
Yep. I couldn't agree more. If you have your reserves prepared, and they're just reserves, you don't necessarily need to spend them, and if you do spend them, you just replenish them again. You always maintain a certain level. But if you can get yourself a couple of rental properties, you get some tenants in there that are managed well by a competent property manager, and they're paying your mortgage for you, and you just let that sit, you just keep adding to them over 5 years, 10 years, 15 years. Pretty soon you're sitting on a very valuable portfolio, and that passive income, when you come to retirement age, that can give you huge amount of options that regular Joes that are just working 9-to-5 jobs are never going to have. So I agree, and they need to work with people like you to make it happen. So if people want to get in touch with you, Kristine, to learn more about the mortgages that are available, or if people are thinking about getting a mortgage in the kind of Tampa Bay market, how can they get in touch with you? What's the best way?
Oh, I'm an old-fashioned kind of girl, Colin. I love the conversation. So my phone number is always available. My office line forwards to my cell phone. My office line is 813-379-3180. But email is a great way to reach me. I am on the phone a lot. So email is Kristine, my first name with a K, Kristine. Last name is Bredeau, B like boy, R-E-D like dog, E-A-U, at Eagle, HM for homemortgage.com. So Kristine Bredeau at EagleHM.com.
And I'll put that email address and that phone number on the podcast show notes as well, in case people didn't catch it. So yeah, thanks a million, Kristine. That was really, really useful. Really appreciate it. And talk to you again soon, okay?
My honor and pleasure. I'd love to come back anytime, Colin.
So there you have it, folks. That was Kristine Bredeau talking to us on Torcana Podcast 19. I thought she provided some really useful insights into the Florida mortgage market from an investor's point of view. As you'll have noticed, it's a very fluid market. Things are always changing. So it's always worthwhile to talk to people like Kristine if you're thinking about applying for mortgages or mortgages for investor loans. There's a lot of stuff you need to look into. I was particularly happy that she talked about getting pre-approved, not just pre-qualified, but pre-approved. That puts you in front of the queue as far as I'm concerned. If you've got your stuff organized, if you've gone through all the credit scores, given them all the bank statements, I know you're going to be ready for a loan. You're going to be ready for a loan with other sellers as well. So by all means, if you have decided to buy rental properties, go ahead and get that pre-approval, and also make sure you've got those reserves. Make sure you're aware that the bigger deposit you put down, the better interest rate you're going to get. Everybody wants to put down as little money as possible, but there's always a flip side to that, and the flip side is that you're getting a lower interest rate with a 25% deposit than you are with a 15% deposit. And just use these to your advantage. Interest rates are still really, really low. I mean, just compared to what they were 8 years ago, 10 years ago, 20 years ago, 30 years ago, pretty much any time, other than the last 3 or 4 years, they're extremely low, and chances are they're going to continue staying low, certainly below 5.5% for the foreseeable future. So, keep searching. Rental properties are a great way to make money, a great way to earn a passive income stream. Obviously, leverage is a very important part of that. So thanks again for listening. Really appreciate all your support. If you like what you're hearing, please leave us a rating or a review. That helps with our iTunes ratings. And I'll be back soon with Torcana Podcast 20. So I'll leave it there for now. Have a great day. This is Colin Murphy signing out. This recording contains general information relating to the real estate market, and it is for educational purposes only. Buyers should always seek appropriate legal, tax and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. While we have no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Opinions of the host are not necessarily shared by other employees and partners of Torcana and its subsidiaries.